Hello everyone, I'm Hui Shi from the iFAST research team. Despite being regarded as an inflation hedge, Singapore REITs, also known as S-REITs, have been battered by rising interest rates. In the middle of 2022, we did warn investors that higher rates are likely to have a profound impact on S-REITs. Fast forward to today, the sector, as gauged by the FTSE ST-REIT index, experienced one of the biggest sell-offs in history and chalked up losses of negative 11% in 2022. Consequently, S-REITs have significantly underperformed the STI, which recorded a total return of around 8% during the same period. At the macroeconomic level, we do not see a favorable backdrop for REITs. We believe that the world is moving into a new regime where inflation is in a structural shift, characterized by shortages in commodity and labor markets. Inflation will possibly take much longer than expected to moderate, and interest rates remain higher for longer. And with this, REITs are being forced to refinance their expiring loans at higher rates, resulting in a higher average cost of debt. Take for instance an S-REIT, which currently has an average cost of debt of 2.5%, considered as low since it managed to lock in lower interest rates over the past few years. Now suppose that the average cost of debt moves towards 4%, which is not a wishful thinking if the Fed's terminal rate reaches 5% and rates are held at an elevated level. On a like-for-like basis, the increase in interest expense from higher borrowing costs will likely result in a decline of around negative 20% in DPU from today's levels. To be sure, this is for illustrative purposes. As an actual practice, the cost of borrowing does not jump immediately and the impact of DPU could be lesser than the estimated negative 20%. Persistently high inflation may not be the worst that is to come. The US and Europe are projected to slip into a recession due to the Federal Reserve's monetary tightening and the energy crisis, respectively. And closer to home, Singapore's forecasted GDP growth in 2023 has been reduced to 1.8% amidst concerns over a global economic slowdown, according to the latest survey released by the Monetary Authority of Singapore, MAS. Accompanied with stubborn inflation that a global economy is unlikely to bring down, we believe that the world could be headed for a stagflationary environment. The implication for REITs is the likelihood of a broad slowdown in commercial leasing activity, which could put downward pressure on rental rates and the potential for DPU deterioration. The macroeconomic environment that is fraught with uncertainties may also drag on the pace of acquisitions as REITs exercise prudent capital management. DPU growth could weaken as acquisitions, besides rental reversions, are deemed as a growth driver for REITs. Furthermore, property values could be challenged. Property valuations are a function of discount rates or capitalization rates, cap rates, as well as net income. The estimated fair value of a property would decrease if discount rates or cap rates rises due to higher interest rates. On a similar note, a drop in net income in face of recessionary or stagflation challenges would result in a lower property fair value. Altogether, we foresee a perfect storm coming for REITs. DPU growth is likely to be lower or even negative in the new economic landscape, marked by slow economic growth and higher for longer interest rates, thus putting a pressure on share prices. Moreover, signs are pointing towards a reduction in property valuation, which can translate into a lower net asset value, also known as NAV, for REITs. Investors who are looking at the current PB ratio of 0.9 times for the sector should not be fooled into thinking that they are snapping out S-REITs at an attractive discount. Breaking S-REITs down into different subsectors, we recognize that there are different diverse factors driving their performances other than the macroeconomic outlook. Now, 2022 was a challenging year for retail. Even with the relaxation of safe management measures and border restrictions, the Singapore retail market continued to face headwinds stemming from persistent inflation and manpower shortages. As a result, there was some resistance in the recovery of the retail rental market, with rents in the central region extending its decline from 2021. Meanwhile, the largest commercial S-REIT, CapitaLand Integrated Commercial Trust, saw a negative rental reversion of negative 4.3% year-to-date as of 30th September for its downtown malls. In our view, the retail market is not going to do any better in 2023. High inflation and the global growth slowdown are likely to weigh on consumer confidence and reduce retail spending. We are also mindful of retailers continuing to face fundamental challenges such as manpower shortage, higher operating costs, ongoing competition from e-commerce, and an impending GST hike. That being said, not all retail is made the same. Suburban malls that are anchored by essential spending, such as groceries, should provide resiliency amidst the macroeconomic challenges. Traffic at these types of retail assets have also proven to be defensive against e-commerce trends. In contrast to retail, the Singapore office market saw favorable demand and supply dynamics in 2022, leading to higher rents. Nevertheless, we are cautious about the market's future performance against the backdrop of a global growth slowdown. The macroeconomic headwinds have caused some firms, particularly those in the technology sector, to announce a hiring freeze or layoff. With firms becoming more conservative in their hiring or expansion plans, leasing demand is likely to be impacted, thus softening the rental growth trajectory. We believe that quality office assets in prime locations are likely to outperform in the flight to quality amidst recession concerns. Occupiers should prioritize office space quality to help attract and retain talent. And looking beyond the near-term headwinds, Singapore remains an attractive place for businesses to grow. The nation is also expected to benefit from the relocation of multinational companies away from Hong Kong as the past rigid COVID-19 rules and increasing influence of China lessens the appeal of Hong Kong as a global financial hub. The rental of Singapore industrial properties also recorded strong gains in 2022, largely led by warehouses due to favorable demand and supply dynamics. In line with this, CapitaLand Ascendas REIT saw a robust positive rental reversion of 14.6% in the third quarter of 2022 for its Singapore logistics properties, contributing to an overall portfolio rental reversion of 5.4%. Though growth in the industrial property market is set to moderate in consequence of prevailing global uncertainties and an increase in supply, secular growth trends from elevated e-commerce penetration and supply chain diversification, such as the China Plus One strategy, should sustain demand and provide resilience for the logistics segment. Data centers are another group of real asset class that benefit from secular growth trends. Digitalization, investment in 5G technology, and the rise of the use of social media are some of the major factors driving the data center market. Notwithstanding the rosy long-term outlook, there are a few things that investors need to be aware of in the current environment of high inflation. First, data centers tend to have long leases, which may impede their ability to adjust swiftly to the high inflation. Data center REITs with leases that come with rental escalations based on the CPI should be able to outperform. Second, data centers are also intensive users of energy, implying that REITs see impact from rising electricity costs. We are wary of rental reversions and escalations not being to fully offset the impact of such higher costs. Data center REITs that are able to pass on higher utility expenses to customers, or if the customers source electricity directly from power suppliers, should be relatively resilient. Healthcare REITs possess defensive characteristics. Rain or shine, everyone needs healthcare or will at some point in time, underpinning its ability to weather through rocky economic times. However, there are very few healthcare REITs in Singapore, with the S-REIT sector consisting of only two healthcare REITs, Parkway Life REIT and S-REIT. While the share price of Parkway Life REIT has retreated by over negative 20% in 2022, it is still trading at a steep premium to book value with a current PB ratio of 1.6 times and remains expensive relative to the broader sector. More importantly, we see P-Life REIT as unattractive to income-seeking investors. At a forward distribution yield of around 4%, it hardly provides a reasonable pickup over risk-free assets. Meanwhile, S-REIT seems more attractively valued. Nonetheless, we are cautious about execution risk as S-REIT is currently pursuing a 2.0 growth strategy involving plans to diversify into developed markets, reshape portfolio for capital-efficient growth, strengthen capital structure to remain resilient, and continue to pivot to ride megatrends. Hospitality REITs were among the best performers within the S-REIT sector in 2022 as they benefited from pent-up travel demand and the return of large-scale events such as the F1 Singapore Grand Prix. As compared to the broader sector, hospitality REITs can also provide a more effective hedge against inflation as they are able to raise prices almost immediately, provided that there is sufficient demand. Nevertheless, it should also be noted that most hospitality REITs are subjected to master leases comprising of fixed and variable components, and hence unit holders may not receive the full benefits of any price increases. Moving forward, however, we are cautious on whether the strong recovery seen in 2022 can be sustained. We note that business travel is seeing a gradual recovery and could be hampered by a global growth slowdown. And even if travel demand remains robust, the world is running short of airplanes. Plane-making giants Boeing and Airbus are encountering supply chain issues and labor shortages, leading to backlogs that will take years to fill. The end result of this will be less affordable airfares. Meanwhile, although China, a key source market, has moved to ease its zero-COVID policy, a deep-rooted fear of the virus presents yet another roadblock. The recovery from COVID-19 measures will likely take some time, as we have doubts on whether the Chinese will be keen to travel abroad so soon. Additionally, a growing number of countries have imposing new restrictions on Chinese visitors due to the rapid rise of COVID-19 cases in China. With the mixed outlook for the S-REIT sector, we are not convinced that it is presenting investors with an attractive risk-reward proposition. While the share prices of S-REITs have fallen since our last update, resulting in higher yields as compared to the start of 2022, we would like to highlight that bond yields have also risen quickly. Thus, the yield spread between the S-REIT sector and the Singapore 10-year government bond remains at a multi-year low and below the 5-year average of around 3.6%. This suggests that investors are now compensated with a lower equity risk premium. The "there is no alternative" narrative is increasingly being challenged, and investors no longer need to rely on REITs to generate attractive yields for their portfolios. Risk-free assets such as Singapore T-bills and Singapore Savings Bond are already offering competitive yields of around 4% and 3% respectively. Investors who are willing to take on a little more risk can also generate juicier returns with SGD-centric bond funds. And at present, the Singapore 10-year government bond yield stands at around 3%, and we see the potential for long-term yields to move up further due to our view that markets are underestimating the persistence of inflation. If one agrees that the Singapore 10-year government bond could reach 4%, and add that with the historical yield spread, investors should be expecting a yield of more than 7%. To get to such levels of yield, the share price of the S-REIT sector needs to fall by more than negative 10% from today's levels, as the sector is currently offering a forward distribution yield of 6%. And in our view, thoughtful selection is required when investing within the S-REIT sector. Besides taking into account valuations, investors should look towards large-scale REITs with sound fundamentals, such as being mindful of high gearing ratios and whose growth are supported by structural tailwinds. We'd also want to highlight the risk of investing in small-cap REITs. They may offer higher yields, but lack the scale to adjust to the change in macroeconomic environment. As the appeal of S-REITs remains dim, investors on the hunt for yields may consider the fixed income asset class for better risk-reward. Today's bond yields are at their highest since the global financial crisis, underpinning the growing attractiveness of fixed income. We have high conviction in SGD-centric short-duration bonds, as well as our recommended bond funds currently hold portfolios that yield around 5%. And with that, I have come to the end of my sharing on our 2023 outlook for the S-REIT sector. Thank you for tuning in and see you again next time.